Hey, good morning. Let's see if this works. Hey, welcome to Oregon Cash Flow Pro. Brian, how you doing? My name is James Barber. I'm here to help you maximize your cash flow. Let me know if you can hear me. I was having some issues getting this started. It actually started the wrong one. It looks like we're going though. So just give me a confirmation that we're good to go. Audio better now. Okay, good. Yeah. I've been having some issues. For some reason, YouTube is suddenly duplicating my stream. And like I click on which one to start, and it starts next week's or the one after that. So glad to hear that the sound is good. Way out west, how you doing this evening? CDG, good evening. Terry, good evening. And Brian, how are you doing? How is Giga Texas out there today? So this is our Wealth Care Wednesday live stream where I'm here to answer any financial questions that you might have. So if you have any, put them in the comment section, put them in the chat, and I will do my best to answer them. You guys have me for the next hour or as long as my voice holds out. Because unfortunately, this does come at the end of a day of meetings. Comes at the end of a day of long meetings where I basically talk most of the day. How's everybody doing? How's everybody doing? Boy, another bloody Wednesday in the market. Stock market saw a lot of red today. And that's just seems to be par for the course on Wednesdays, doesn't it? Tesla had a really good couple of days to begin the week. Today kind of put us back into check. And I'm looking for a bounce tomorrow, though. Terry doing good? All right. Well, what are you guys up to? What are you doing? I want to hear from you. Tell me in the chat. What are you doing to take care of your wealth, or to grow your wealth, or to maximize your cash flow? What are you doing to maximize your cash flow? John with a question. In an IUL policy, is the agent commission based on the face amount and not the term amount? In an IUL policy, all of the insurance is term insurance. So we have the base face amount, and then you typically have a supplemental term or an additional protection benefit, which is the same thing. It's a supplemental term policy. And so it's kind of, I know it's kind of weird to think of term insurance being blended in with other term insurance. But in effect, all of the insurance is annual renewable term in an IUL. The difference between the base face amount and insurance that's blended in with that supplemental term is the agent's commission. The agent's commission is based off of the base face amount, and any death benefit that we add in that supplemental term column does not pay a commission. So that's one of the keys to an optimal design. An IUL policy that is optimally designed for the client's maximum cash value benefit is going to have the smallest base face amount possible and the largest supplemental term blend that they need. Now, most insurance companies have a ratio that they will allow you to do a split on. And that's a base face amount of 1 and a supplemental term amount of 3. So a 3-to-1 ratio is what nearly every company out there will allow, including in whole life. In whole life, it's very similar. Although Guardian will allow a 10-to-1 split, and Allianz will allow a 10-to-1 split. Any idea which companies I write the most? Guardian and Allianz. Allianz, if you're between the ages of 18 and 50, they will allow a 10-to-1 split between the base face amount and that supplemental term amount, which is way more than any other carrier out there for IUL. How does that benefit you? Well, the agent's commission is based on that face amount. So, if we have $1 million in term insurance, and I've got to do the base face amount of $300,000, no, close to that, $250,000 and $750 with a 3-to-1 ratio, or a $100,000 base and a $1 million supplemental term, which one do you think is going to end up playing out better as far as the cost in the policy? The one with the bigger split. The 1 to 10 is going to be the lower cost to the policy. So that's what Allianz allows me to do. It's why Allianz is currently my favorite IUL carrier. It allows me to give the maximum benefit to the client when we design these policies. We're going to do what we can no matter which carrier we're using. But, you know, Allianz lets us do just a little bit more than some of the other ones do in that regard. CDG says, I think I saw that the term rider on the Allianz is convertible to base within 10 years or so. What benefit would it serve to convert the term to base on an IUL? That's a great question. And I asked the exact same question from the regional director. And the answer is there is no benefit to the client for converting that base. Because, and this was the reason I asked, why would I want to convert? What exactly am I converting? Because it's all annual renewable term. It's actually the exact same kind of insurance. So what am I converting? And the answer was nothing. Some agents may want to design it to convert. There's different ways that an agent can choose to take their commission. You can choose to take your commission in 1 year, or you can choose to take your commission over time. And if an agent chooses to take their commission over time, they can design that policy to have a bigger supplemental term and then convert it each year, thus giving them the full commission that they would have otherwise got each time that gets converted. So the only benefit to converting is to the agent who takes their commission over time. It just gives them more of a payout. And what does that do? When I design a blend, when I design that maximum blend, and I compare that to that maximum blend where I convert it over time, the one that converts turns into less cash value. So, no benefit to the client, benefit to the agent. I don't know why they do that. It adds a little bit of a complication in there, but something to watch out for. Just know as a client, there's no reason. There's no reason to convert it. The term insurance that's part of that supplemental term, it does not end. It's not a level term. It doesn't go away. It's the exact same kind of insurance. It'll be around as long as you keep making payments on that policy. So hopefully that helps. Oliver, good evening. How are you doing? What did I eat today? You're always talking about food. I had my granola bars. I had, my wife made me a pretty killer taco salad for dinner, which I had right before we got on here. And for lunch, what did I have for lunch? I had a few pieces of bacon that I heated up. A few pieces of bacon and a bowl of cereal. Yeah, you love food, I could tell. David Yadagarians, how are you doing? You're losing lots of money on coin. Oh no, you got in on coin. Tell me your story. Tell me your story. For one, I was in meetings all day. And I was in meetings when coin came out. But I wasn't planning on playing coin anyways. Coin reminded me of the hype that came along with Airbnb. And the expectation was that it would come out with the IPO and it was going to be very expensive. Airbnb delayed their IPO in order to get more money out of it. And they waited and waited throughout the day as the price went up and up and up. And they basically took all the motivation out of the market to hop in on it and push it up in order to get really good gains. You know, the retail investor didn't really have that opportunity in Airbnb. So Airbnb, it finally was released. People bought in right away, and immediately, it went up a little bit and it just started to sell off right away because it was already overpriced. And when you get to that high prices, a lot less people are willing to buy in. So Airbnb was released with like $145 price. Coin ended up being released at like 360 something. I don't even remember what the amount was. I didn't look it up afterward. But it was in the mid 300s. A really, really high price. And because of that, not a whole lot of retail investors are going to be hopping into that, hoping to make some money. So, some people hopped in on it, pushed it up, and immediately it came right back down. And a lot of people got stuck holding the bag. So, what was your story? Krish, you have a question. You had to sell an option for cheap so you could get something back out of it. You sold for 5, it filled for 5, but in your account, it only says 490 unsettled. That's interesting. I'm not sure why it would say that. If you sold it for 5, what platform are you using? Because maybe there's a cost for you to do options. In which case, that would make sense. It might cost you, that's $10 though, right? Or did you sell it for, you sold it for 0.05, which is basically $5. And, oh yes. So I believe there's a cost. There's a small cost for each options closed not with your broker, but with the financial regulators. So with FINRA or the SEC, something like that. And so that's probably that 10 cents. I'm guessing you have Webull or Robinhood, and you probably looked at your statement afterward and you see that 490. I'm guessing Webull. But that would be why. You probably got 10 cents that was charged there from whoever gets a little tiny fee off of the options. Mr. B, how are you doing this evening? A1, good evening. When it comes to PUAs, does it make a difference if you submit PUAs at the beginning of the policy versus closer to the anniversary date? Highest return on investment is the goal. Yes, it does make a difference. So, actually, let me caveat that. It makes a difference if it's a scheduled PUA or an unscheduled PUA. If not every carrier will allow unscheduled PUAs, but if you have scheduled PUAs and they're split up over time, some of them will come in, some of them will be paid, let's say it's monthly. Some of them will be paid near the beginning of the anniversary year, some of them will get paid at the end. What your insurance company does, if it's scheduled, they will credit all of those PUAs that are scheduled with the full dividend amount. If you have unscheduled PUAs, however, they don't know that those are coming in. So there's no way for them to credit you the full dividend amount at the beginning of your policy year. So the unscheduled paid up additions will not get the credit until they get in there. So those will be prorated from when you pay them up later on in the year. Make sense? So if the maximum return on ROI is wanted, try and get those paid up additions in the first 30 days. If you get them in the first 30 days, you should get your dividend for the whole year. Hope that helps, A1. Way out west, you've been doing research to try and quantify the risk reward of various base versus paid up additions. All right. I touched on it. Hang on, I gotta sneeze. I touched on it in my 70-30 versus 90-10 video. Can I provide more details about the risk of dividends and PUAs? Okay, so when it comes to the different design splits, dividend payout from the insurance company is going to be the highest on base premium. When an insurance company declares their dividend for the year, that's just a gross number. That's kind of like the average number. They don't pay out that same amount to every policy that they own, to every policy that they are contracted with. It varies based on your age, your health rating, how close you are to fulfilling your obligations there, paying that base premiums, if you've done a reduced paid up, right? And how much base premium or how much PUA you're getting. All of that can affect your actual dividend payout. So, the base premium gets the biggest dividend. Just in general, the base premium gets the biggest percentage of dividend. Let's say, as an example, the dividend rate might be 6%. The dividend rate might be 6%, the declared dividend rate. What the base premium on one policy might see might be 6%. The paid up addition portion of that policy would likely get just the guaranteed 4% growth. Okay, it's going to at least get that 4% guarantee. It might get more than that, but you get the 4% guarantee. Okay, so we're just going to assume it gets the 4% guarantee. Now, one might think, why don't I just do base premium then and get that higher dividend? Well, the reason you don't do that is because the underlying cost in the policy is a lot higher. The 4% guarantee on the PUA is going to pay out beginning in the first year. If you only go base premium or you do a higher split or whatever, that 6% may apply to let's do a all base premium policy. So if you put in $100,000 into the policy and it's all base premium, you're not going to have any cash value in the first 2 years. So that dividend payment is not, you're not getting any dividend payment for the first 2 years. There's no cash value for it to accumulate on. You're getting a little bit in the background. You might get a little tiny bit. But for the most part, the dividend then starts to grow after those first 2 years, and it starts to generate cash value. Because you don't just get the dividend on the base premium, you're getting it on the value that's in the policy, the cash value that's in the policy, and the percentage of that that they figure out based on the base premium and the dividends. It's a little bit complicated, as you can tell. So, with a 90-10 design, we end up in that first year with 90% cash value, or close to it, close to 90% cash value. A little tiny bit of that, well, in the first 2 years, none of that's base premium. So our growth in the policy those years is just going to be that 4% guarantee on the base premium. So immediately, our policy is going to be growing in cash value faster than the pure base premium. Because that one's not really getting anything. It's not really getting much anything at all. Down the road, let's go 7 years down the road. Now the base premium is starting to get a little bit of cash value, but remember, it does not break even until like year 15. Sometimes year 20. I mean, it can take a long time for an all base premium policy to break even. So it's slowly growing in value. And yes, it's going to get that higher dividend payment, but on a much, much smaller amount. Meanwhile, our 90-10 design is getting 6% on that little tiny amount of base premium and 4% on the big, huge amount of cash value that we've been generating in there. And so it's growing in cash value leaps and bounds ahead of the all-base premium policy. Theoretically, 30, 40 years down the road, you can still keep contributing more money into that pure base premium policy than the blended design. Possibly. It depends on the carrier that we're using. And you're going to see a number that's higher under the dividend payout column. But the actual growth in the policy, almost every time, throughout the whole life of the policy, is the actual growth is going to be higher in the 90-10 design. That's been my experience when we compare the same carrier with the 90-10 design, 60-40, 70-30, all base premium, any of those designs. If you're comparing carrier to carrier, the one that has the lower base premium ends up with a much higher cash value at the beginning of the policy and all the way throughout it, including a higher death benefit. When might that be different? That might be different if the dividend rate changes drastically in the future. Remember, we're in a very low dividend rate environment right now, which is partly why that higher base premium or that higher blend, the lower blend, it takes it so long to catch up, and it actually never catches up to the other design. Part of that's because those dividend rates are just not high enough. Now, if we go back 20 years and the dividend rates are 8, 9, 10%, if we get back to that environment, you'll probably see those policies perform better. They will end up passing in cash value compared to a 90-10 design. But are we going to get back into that type of dividend rate environment? Who knows? And if we do, when? So are you going to, when you try and decide on your policy, are you going to pay a lot more in commissions to the agents? Because that's one of the biggest effects with the 90-10, 70-30 whole life or all base premium policy, is that 10 in the 90-10 and the 30 in the 70-30. That's the amount that determines the commission to the agent. So in a 90-10 design compared to a 70-30, the agent's going to get 3 times as much commission in that 70-30 design. And in a pure base premium policy, 10 times as much commission. So you've got to decide, do you want to pay a whole lot more in fees? Because that's what that is. That commission comes out as fees in your policy. That's why there's not much cash value growing in the early years. Do you want to pay a lot more fees at the beginning to your agent on the chance that down the road, 10, 20, 30 years down the road, the dividend rates are going to go up high enough that it makes it worthwhile? And you give up that early liquidity in your policy. Now, for me, personally, I'm not going to make that bet. We're in a very low interest rate environment. We've been in this environment for the last 10 years. That's why dividend rates keep coming down. And I expect we're going to be in this low interest rate environment probably for another 10 years. And it may go on longer than that. With the way that our government gets ran, low interest rates is the crutch that we need to keep this economy going. So every time they try and raise the interest rates, the economy crashes. How is that going to change in the future? I don't anticipate it's going to change much in the future, which means I think it's highly likely we stay in a low interest rate environment, which makes it very challenging for insurance companies to pay out very high dividends. So I don't think it's going to change. I would rather go with what we have now and what I anticipate in the near future and lock in much greater liquidity right now and greater potential gains all the way throughout the life of the policy. I mean, we got to trade. It's like trading in the stock market. You trade off what you know and what you can see, right? You don't trade off what might happen 30 years down the road in the future. Now, you can invest for that in the stock market, but hardly anybody just puts all of their money into something that might take 30 years to pay out, and it may not pay out, when you've got the opportunity to put it into something that pays out right away a lot better. So, take your pick. I know what side I'm going to be on that choice. All right, next question. David, not lots of money, just like 1.4K so far. Buying before ARK buys in to skyrocket the price. You think ARK, you think ARK's going to buy into coin, huh? Interesting. They might. They might. I mean, if they did it, they would probably have done it the first day, I would think. That's what they did on Roblox. Bitcoin will be over 100K by the end of the year, David says. His thinking is that millennials open a crypto trading account before a stock trading account. True, but here's the big but. Coinbase charges really high fees, which is why they made a whole lot of money. Coinbase Pro, on the other hand, does not charge a whole lot of fees. So the people that are buying into Coinbase are largely new entrants into the crypto space that don't know any better. How long before they realize that they're spending a lot of money on fees that they don't have to be, and they transfer out of there? That's what you got to watch out for with coin. Yeah, I don't know. I don't know if that's a sustainable. I don't know what they're going to be able to do to sustain that type of income, because you can't just charge more fees than everybody else out there. They don't offer anything else that I'm aware of that would justify people paying that fee except for their ignorance. That's really it. And eventually, most of that ignorance is probably going to go away as people start realizing, crap, I'm spending a lot of money on fees here that I don't have to. So, something to watch out for. Chris using Webull. Okay, yeah. So I got your answer there. Hopefully that helped you out. Yeah, always 10 cents. That's the cost from the SEC or FINRA. One of those folks. Mosh, how are you doing? Been a while. If you had 20K in your Roth IRA, 10K in my trading, which stock would you go into right now? Good question. I need a little bit more detail though. What is your goal? What is your goal with it? Like, are you wanting to just buy something, set it and forget it? Are you wanting to, in your Roth even, are you wanting something to swing trade or day trade? Do you want something that pays out a dividend? What are you looking for beyond just, I have X amount of money, what would I do with it? Tony, afternoon. Thanks for dropping a like. I appreciate that. Way Out West says, thanks for answering my question and thank you for the level of detail. I've not seen, read, heard it explained that in depth. Happy to help. Happy to help. I also mentioned that dividends pay for the blended riders and that they may not be enough to pay the riders in full. What do you do when that happens? Pay more or allow your policy to be affected? Okay, so what you're referring to, this is one of the risks that I didn't mention earlier. So one of the risks also with the higher blended design, there's some assumptions that get made in there. And some of those assumptions are that we're going to get a certain amount of dividends that's going to buy paid up additions. So that growth in the policy is going to buy paid up additions. Well, if dividend rates come down, you may not get enough paid up additions bought in order to match the illustration and keep it from becoming a mech with how much money you're putting into it. So, is this a big risk? Not really, because the solution to that is you just have to withdraw a little bit of money. So, if you put in $100,000 and the dividend rate drops a little bit, and now that $100,000 doesn't generate enough paid up additions to keep the policy performing as expected to keep it from becoming a mech, in order to fix that, you might have to pull out a couple $100. Probably at the most a couple $100. It's not going to be like out of this world. You've got a mech and it's a nightmare to fix it. Not the case. The way to fix it is to just withdraw a little bit of what you put in. So if we have a policy design where you can put 100,000 in and you get this really good liquidity at the beginning, and the risk is maybe you only put in 99,500 in order to keep it from becoming a mech down the road, it's not that big of a risk. Not that big of a risk. So that's how your policy is affected if the dividend rate comes down and it doesn't buy quite enough paid up additions. Now, keep in mind, we're in a low dividend rate environment already. There isn't a whole lot of room for it to keep coming down before we run into the guarantees. It depends on which carriers you're using. A lot of carriers are already below the 4%, but the top ones that we like to use are up around 5.65 to 6%. Okay, so there is still some room for those to come down. But like I said, we've already been in this challenging environment. If things turn around even a little bit, they should be able to hold the dividend payments that they're currently at. But even if it comes down a little bit, I don't mind. I mean, you just don't contribute quite as much as we designed. It's not the end of the world. Certainly, you don't have to make it turn into a mech. Those are pretty easy to avoid. And you can't just pay more. That's part of the issue. Most of your carriers will not just allow you to pay more. Some of them might, but some of them just don't allow that type of thing to happen. Okay, they won't let you put more money into a policy without going through additional underwriting. So that's something to watch out for. Okay, you can't just, if they do allow it, you could just pay more, and that would fix it as well. If you just were able to buy some more paid up additions, that would probably fix it as well. But worst case scenario, you just take a little bit of money out and you're good. Tony, the quick flip paid off in GME. Lucky, lucky, lucky. Nice. Yeah, I saw it dropped afterward. It shot up pretty good, though. So you were able to get in and get out. That's awesome. Hopefully we'll see it head up again tomorrow or the next day. I've got a spread. I've got a 190 to 195 debit spread that I opened beginning of the week. I think I opened it at the beginning of the week. It was whenever we heard that Ryan Cohen was going to be upgraded into the president or CEO or whatever, and the news and the stock price dropped after that news came out. I was like, what the heck? That news dropped. It shouldn't be dropping. So I bought a debit spread expecting it to come back up. Sure enough, it didn't come back up. It kept going down, down, down. I paid like $1.10 for that debit spread, and it went down to like 10 cents. No, I paid $1.15 for it. It went down to like 10 cents. Well, today, it came all the way back up to $1.15. And then it went back down to like 90 cents. So hopefully it'll come back up tomorrow or the next day, and I'll be able to get out of that thing for a profit. But I thought that was pretty neat to see that come back up. Okay, Mosh. Tony says, SPACs have been hard hit. Pick a good one and run with it. Yeah, I'm not a big fan of SPACs anymore. I'm kind of avoiding those. Okay, Mosh. Oh, you just repeated your question a whole bunch of times. Why did you do that? You got to give me time to get through. You got to give me time to get through my my answers. I will get to your questions, but I do need more information for yours. Krish, can I look at Ford for you for your $17 call? 1267 BEP. What do you mean by 1267 BEP? You got 9 days left. I'm not sure what 1267 BEP means. A1 says, thanks for the great info. How do you address the common objection, you lose your cash value when you die? Good question. You don't really lose your cash value when you die. That's the problem. If you look at, let's say, the argument's a little bit different if you go whole life or IUL, but in nearly every case, if you have an increasing death benefit set, there are some whole lives that you can see an increasing, even with the blends that we do. And there's IULs where we can do a level or a option B death benefit, which is an increasing death benefit. You have a death benefit amount that you pay for. That's the cost of insurance in your policy. In the IUL, all of the cash value that grows adds on to that death benefit that you're paying for. So if you look at the illustration, you do get all of the cash value and the death benefit that you're paying for. Now, if you want a higher death benefit when you pass away, pay for more death benefit. If you use a level death benefit, which some whole life insurance policies look like when we do the blend, or a level death benefit on an IUL, you're not going to see that death benefit grow as your cash value grows. But what happens behind the scenes there is, as your cash value goes up, the amount of net amount at risk, the amount of death benefit that you're paying for, goes down. So you do, in nearly every instance, you get the cash value and the death benefit. It's just a matter of how much death benefit do you want to be paying for. But the death benefit, when it pays out, is a mix of the death benefit you paid for and the cash value that you've built up. It just all goes as a death benefit to your beneficiary so that they can get it tax-free. Make sense? That's what I tell my clients, because I do get asked that regularly. It's a good question, and I love to show them how in the illustration, look, the death benefit actually does go up. And what you're paying for does not. It's going up because of that cash value. Okay, Mosh, you want to buy, set it and forget it. I'm assuming in both of those then, in your trading account and in your Roth. If I was going to buy a set it and forget it, I probably wouldn't just buy one stock. Depends on how much. Let's see, you got 20,000 there, 10,000 in the other one. I don't do much set it and forget it anyways. I like to use options to maximize the use of that asset. So I would prefer to buy a stock that I can buy 100 shares of at least, so that I could sell covered calls against it and increase my position. But if I was just going to buy a stock, set it and forget it, I would want some Tesla. I would want some, depends on how long you're going to forget it for. I would get some NNDM. I would get probably some Palantir. I would get some NEO. And let's see, there's 4 there. I would probably get some Apple. And that might be about it. I would probably do some of those. Those are probably not going to do all that great in the short period here. They might, but growth stocks are taking a hit. But we're talking set it and forget it. Where are these companies going to be in a few years? 5 years, 10 years? I think they're going to be a lot higher than where they are now. And I think if I was buying into those, I would be pretty confident we'll be beating the overall market in the long run. Like the S&P 500 index, Dow Jones, we'll probably beat those if we buy those stocks and just set them and forget it. Krish, I will take a look at your forward call here in a little bit, but I need to know what you meant by those numbers. I'm not sure what that BEP means. Way out west, you're welcome. Tony says, hope you got in last year on the Ford. Krish, they got some problems coming with EVs. They're outsourcing their EV tech. He says they're dinosaurs in the tech world. Well, I mean, they're going to partner with NEO for charging in China. So I wouldn't dismiss Ford quite so easily. They've got the best-selling truck in the country, in the U.S., and a lot of fans. There's a lot of fans of Ford. So if they can get an electric Ford F-150, it's going to sell. If they can make it affordable, that's going to be the key. If they have to outsource their EV tech to make that affordable, so be it. But I wouldn't write them off I definitely wouldn't write them off. Their stock is really cheap too. It's like 12 bucks. So it's not a very expensive one to get into. Makes it a lot easier for people to buy. I wish, just imagine if Tesla was down at $12. How many stocks would you be buying each week? Quite a bit, I bet. Just because it's easier. It's easier to buy it. You know, it's like you can just throw a little bit of change at it each week. So Ford fans could be doing that as well if they wanted to. BEP, break-even price. Thank you. Sometimes I'm just not in the right mindset and I need some context. Oh, do I think it could hit 1267 in the next 9 days? That is not really the question that you want to ask. When you buy, I'm going to pull it up here. So give me a second. When you buy an option, you're not just buying the strike price and the break-even price that you think it can get to by expiration. Part of what you're doing is you're buying the belief that it can get there. And what happens with that belief before we get there? That belief is called time value. Time value. It's theta. Okay? And every day that it doesn't reach that target, some of that time value goes away. It's called theta decay. Some of the belief that it can get to that strike price goes away. And along with that, the price of your option goes away. So let me pull up Ford here. Let's see, indicators. I want MACD, RSI, and stochastic. Okay, let's take a look. Let me see if I can share this with you. Give me just a second. All right, here we go. So right above me is the Ford daily. It's the Ford chart on the daily. Okay. So it looks like just recently it was up to 13.6. And it's come down, came down to 12.10, went back up to 12.90, almost 13. Now it's back down to 12.24. So 12.67, yeah, it can hit 12.67 in the next 9 days. I don't know why it can't, at least according to the chart, right? There's a lot of support. There's a lot of support that was built in right here at the 12.05 mark. Okay, so you still have some time value built into this thing. I don't know what it's going to be doing. I don't know when earnings is for Ford. I imagine they probably have an earnings call coming up here soon. You're going to want to look that up. See if they've got earnings. But the big thing is what does it take to make a profit on your trade? What does it take to make a profit on your trade? We've got some consolidation going on here, a little bit of an up and down. Right now, we're at the bottom of the Bollinger Band on the daily chart, okay? These are our Bollinger Bands, this green line. Stochastic is down. RSI, it's trying to turn up, but it's under 50, indicating a downward trend. And MACD has not turned over. So odds are, might be a little more downside to come. But we're working on a little green candle here as well. So today was a little green candle. We may end up coming down to this low Bollinger Band in the next day or so. The low Bollinger Band is at 1195. and then we might see it bounce back up. And the hope would be that it comes back up to the upper Bollinger Band, which is right around 12.95. So there's a good chance, unless those Bollinger Bands contract some more, there's a good chance you could get above that break-even price in the next 9 days, okay? So there's definitely a chance. What you're going to want to watch for, this is Webull that I'm using up here. You can do these same charts and the same indicators on your Webull account, okay? What you're going to want to watch for is you don't want to see it go below this low Bollinger Band and push down. That will not be a good sign. That's not going to be a good sign. Let's go to the 1 hour. 1 hour chart. Went up today. Oh, earlier today would have been a good time to sell that option, I bet. It hit 12.45, which is almost your break even. And there's still 9 days of time value left in that option. You got to watch out for these things. A couple of days ago, it was up at 12.62 at the beginning of the day. It looks like the beginning of the day is the best time of the day for Ford. You get the highest prices, and it's been fading after that. So watch for a spike up. Check your option price. See if it looks like a good time to get out. If you actually want to buy the stock at whatever you had, hold the option until expiration, buy the stock. Okay, but for the most part, we're not trading to buy the stocks. We're not doing options to buy the stocks. We're doing it to make some money. So make sure you make some money. Get out with a profit whenever it looks like it's a good time. But you don't want to give up all of your time value. Oftentimes, that time value can be worth more than the actual value, right? So let's get back to our questions. Yeah, Ford's been dissing on Elon Musk for sure, yep. They're definitely threatened. Mosh, why are small caps getting shorted to death? That's just kind of what's been happening for a long time. They're easy. They're easy to short because they're cheap. But also, over the last year, they've been getting really, really high valuations compared to the type of income that they're bringing in. So it kind of makes them a prime target. If you can short the small caps and depress the people who bought in at too high of prices and get them to get out, that's kind of a winning formula. And it's a lot easier to do with small caps than it is the large caps, because you can move that price fairly easily if you can buy large quantities or sell large quantities. Way Out West says, I've seen videos where you compare insurance companies and policy designs. You mentioned Penn only goes to 80/20 and doesn't compare favorably to Guardian. What if Penn does an 87/13? I haven't seen Penn be able to do an 87/13, but Penn does compare favorably to Guardian, just not in the first year. In fact, Penn is one of my top choices when it comes to policy growth overall. Even though 80/20 is about the best I can design it, the cash value in the first year is not there, but it catches up to Guardian and Mass Mutual, my top choices. It catches up to them by about year 6 and then passes. And you end up with higher cash growth and higher death benefit. The only problem with Penn is the 80/20 design, and they're not very flexible. They're not as flexible as Mass Mutual and Guardian. Guardian provides the ultimate flexibility. Mass Mutual doesn't provide much flexibility, but it does provide a little bit more than Penn does. So there's a lot less clients that Penn becomes the number one choice because of how they're trying to fund it. Okay? Way Out West. Obviously, all my questions answer your first question. My current financial situation is I'm looking to implement IBC with a whole life policy. You've been family banking with a 2% earning bank account. Oh, nice. All right. That's definitely a challenge, and you're not getting what you want, what you need to get out of it. The nice thing about using a whole life policy for doing that is you get that death benefit to go along with it, and you get the higher growth. Other than that, yeah, I mean, there's all kinds of things you can do IBC in besides just a whole life policy. Whole life just happens to be a very good product for that because of the guarantees that you get with it and the death benefit. So it ends up meeting some other needs that make up a solid financial base when we consider our wealth pyramid. So good for you. Hopefully that's helpful. Next question. Mosh says, how crazy is this? If you would have put $30K in the TQQQ 5 years ago, that would be $3 million today. Do you think we stay in a bull market? Because if I do, then I'd be rich. The problem with the TQQQ, I don't know if you would have $3 million today. Maybe you would, but I heard some of those, the triple leveraged ETFs like that, oftentimes they'll do a rebalancing. And so that might have happened during that time, which might throw off some of these numbers. But the TQQQ and the SQQQ, which is the short version of the QQQ, they're both leveraged ETFs. The problem with those leveraged ETFs is sitting in them for long periods of time, you might end up, they can go bust. They are not the same as the underlying. They can go bust if for some reason they can't meet their obligations. I don't know what the situation is around that. I just heard it recently in a podcast that I was listening to. So, something to be aware of. Krish, when it was at today's highs, you were up over 50%, but you couldn't sell. Oh, why couldn't you sell? Were you just not were you just not on? Or is it something you bought today? And so you couldn't sell it today because you get a day trade. If that's the case, hopefully you get the opportunity tomorrow. Good luck. Good luck. But yeah, 50%, that's a nice gain. Why do you feel disrespected? Are you just impatient? You can't wait for me to finish answering questions? I've got to get through my questions, man. Tony says, Ford trucks have a strong following. They should concentrate in that area while materials are in short supply. I agree. Way Out West. Didn't know commercials would pop up and play during a live stream. Haven't seen that before. They do sometimes. Yep, they do sometimes. More so when people aren't tipping. A1, same. Krish, today's highs was up 50+%, but you couldn't sell because you bought with unsettled funds. Gotcha. Well, hopefully you'll be able to get out tomorrow. Tony, HOF V getting hammered by shorts this last week. Yeah, no kidding. Definitely feeling that. Palantir, I like Palantir. I've got some positions in Palantir. A lot of excitement around Palantir. I don't know what that means for the stock price because they're not profitable. They're not profitable yet. Maybe they are. I mean, they've gotten a bunch of contracts lately, but they've got some work to do. They've got some work to do to be profitable. So the challenge with any of these highly valued, unprofitable companies is when we get to a point where the market is shifting and people got to decide where they're going to pull their money from and put it into maybe some more value as opposed to growth, or if they just want to take some profits, they're going to do it from the companies that aren't profitable first. So we definitely want to see Palantir become profitable as quick as possible, and just be careful with the stock in the meantime. Kenny Eugene, good evening. You spoke with a New York Life agent today, going down the whole life rabbit hole. All right. New York Life is one of the top whole life carriers. I would love to show you an alternative to that, because I haven't seen a New York Life policy that can be designed the way that I design my whole life policies. Yeah, New York Life has captive agents, so I can't sell New York Life, but I can certainly provide you with something to compare it to, so that you know if it fits your needs good or not. So if you're interested, I'm going to put a link to my Calendly in the chat. You can sign up. We can do a one-on-one, and I can do illustrations for you. I can show you what makes up a good policy design, if you haven't already gotten that by watching all my videos. But I basically go through how I design them, why I design them the way I do, and you end up with a lot more knowledgeable consumer at the end of it. Even if you don't end up going with me, totally fine. Always welcome to meet with me and see what's possible. A1 says, final thought, James. Again, how do you address hyperinflation objection? Client says, what will happen to my policy if hyperinflation happens? Good question. What would happen to your money no matter where it's at if hyperinflation happens? Your money loses value. Same thing will happen in a policy. That $1 million death benefit, if we get into hyperinflation, it's not really going to mean a whole lot. It's not going to mean a whole lot. $1 million, it could be worth $1 million could be worth $100 in a hyperinflation environment, right? In a year or 2 years, right? That's just the reality of the situation in hyperinflation. You're going to have that risk no matter where you keep your money. So if I was to encounter a hyperinflation environment and I keep a lot of money in my life insurance policy, what I would do, I would borrow all of that money out of the life insurance policy. And I would buy an asset immediately. I would buy a house, I would buy a car, I would buy toilet paper. I would buy things that people need. You take that money out, you buy things people need, and when you sell those things to the people that need them for the massively inflated currency, suddenly you can pay off that loan pretty easily. So that's what I would do in a hyperinflation environment. I don't see hyperinflation as an objection to not get one of these policies, because one, it's highly unlikely to happen, but two, you're not in a better position having your money anywhere else, because you can always borrow the money out of that policy and buy stuff with it. Stuff that grows in value along with that hyperinflation. So I hope that helps. Way out west, you got a pen policy design from an NNI IBC practitioner with an 87-13 split, but you're correct about the lack of flexibility. That's causing you to lean Guardian. I would love to see that split. Can you share that with me? Send it to my send it to my email if you would. James@OregonCashflowPro.com. Because if I can design it that way, I sure as hell will. I love to get as big of a split as I can. I don't know how you get the 87-13 though. So the person that trained me on the pen policies was not able to get that. In fact, the first policy that he sent me, the best design was like 65-35. I spent an afternoon fiddling around with the software and I got it to an 80-20. And then I went back and talked to him again and he was like, oh yeah, here's how you do that. So the people that work at these companies, they don't want you designing these policies that way. They don't train people to design policies that way, because it minimizes the commission across the board. You know, they get a cut of that commission ultimately, and they want it to be higher. So they like to see the higher splits. So it's on us as agents to figure out how to do it. I have not been able to figure it out with Penn. Their software is a little harder than some other ones, but so far the ones I've designed at 80-20 have been better than the other ones I've seen out there. So I'm definitely interested in seeing what an 87-13 looks like. Would love to compare that with the 80-20 that I designed. You've seen enough videos and read a few books that has you in whole life or bust for stepping your family bank up to IBC. Right on. Right on. It's a good choice. I do that in my personal life. I have Guardian for my main policies. That's mostly because I can do very large policies in Guardian that I can't do other places. I need that flexibility. A1, thank you. Appreciate that. Appreciate that donation. Did I thank somebody else gave me a donation, and I hope I thanked you for it. Way Out West, thank you. I appreciate your super chat as well. Man, I'm way behind on the chat, aren't I? I must be behind on it. You feel honored that I took the time to answer your questions. That's what we're here for. That's what this whole live stream is about, is me answering your guys' questions. So I'm happy to do it, and I really appreciate you throwing out the tip. So thank you. Tony, bought a couple hundred extra at the 20s that you sold for a quick profit. For Planter. Very good. Looks like 22.92 average. All right. All right. Hesleg, how you doing? Good evening. Finally catching me live. Yeah. Mosh, going to go all in on NNDM. I like NNDM. That's one of my high conviction ones. I wouldn't go all in. I wouldn't put all your money in right away. I would take a substantial position, and just in case it decides to drop, leave yourself a little bit of gunpowder, so if it drops, you can add in an average down. Because what we're waiting on for NNDM is we're waiting for news of an acquisition or two. They're looking at buying a couple of companies, but we don't know what. They've only said that these companies are going to be complementing their current business model. So they've been spending the last year accumulating dollars, getting more and more built up. They've got a ton of cash on hand, and hopefully that acquisition happens this year. A lot of people are betting on it happen this year. So cross your fingers. But that's what we're waiting for. In the meantime, it could go down some more. It's possible it can go down some more. So just make sure anytime you start to take a position in stocks, you don't necessarily want to go all in. Leave yourself with some powder, some dry powder, so that you can average in if the price moves against you. Mosh says, by the way, guys, later on in the year, check cap will rip with FDA approval. Keep an eye open. Check cap. Thank you. Good to be back with your favorite YouTuber. Been crazy busy getting engaged Sunday. Nice. Congratulations. Congratulations. Kenny, break even was 9-year, 9,000 base premium. Which one what are you responding to? Kenny Eugene, let's see. You spoke, New York Life Agent. Got it. 9-year, 9,000 base premium. Yeah, 9-year, that's not great. That's not great, but I would like to see what it does long term. That's the thing. Typically, we get an earlier break even because we lower the commission. We lower the agent's commission. It gives you more cash value at the beginning. All right? Your base premium can be very small. What's your overall premium for the year? Because 9,000 base premium, that's pretty solid. I imagine you're probably paying in, I think New York Life limits you to 3 or 4 times that. So you might be paying in 27,000, 36,000 per year, something like that. And if that's the case, some of the designs we can do, your base premium can be at 36,000 max pay-in. Your base premium can be like 3,600. Quite a bit less. Or even with Penn Mutual, 7,000 base premium. But I bet the Penn Mutual will perform a lot better long term. Yeah, I mean, it just does. Really, really strong dividend paying company. Low roller. Can't believe Dogecoin's still at 13 cents. I have not looked at it yet this evening. I still have a decent position in it. Let's see where it's at. Doge, 12.8. 12.8 cents. I'm up $57 on it. I got 5,000. I got 5,000 Doge. Very good. If everyone gets rich on Dogecoin, it causes hyperinflation. Okay. Tony says there was at least a 25% play on Doge today. Yes, there was. I mean, it was early this morning. Early this morning, it went up 60%. 60%. When I got in on it, it went up 25, or I think it went up 19% after I got in on it. Still massively solid play, but I didn't go in heavy on it at that much, which is unfortunate because at one point this morning I had $5,000 sitting in it, and that would have been nice to catch a 19% jump. A1, you're welcome. You're welcome, and thank you. Adventure, how are you doing? Hello, everyone. He says, just given the results of using my bank's bill pay, they say the check was delivered on the 7th. Money was taken out of your account in the morning on the 13th. Was marked as paid that day in your Mass online portal. And you started the loan process that night to pay off the margin you took to make the payment. Does Mass say when the loan gets processed online? Good question. That's good. I'm glad to hear they got your bill pay. Does Mass say online? I'm not sure. So, and the reason I'm not sure is because since Mass started doing the online processing, I haven't made a payment yet. In fact, it's something new that they started doing this year, and my policy is renewing in just a few days. So I just sent in my payment for it. It should be going in on Friday. So I'm making my payment for this year on Friday, and then I'll be requesting a loan right after that. So we'll see how that goes. So you'll have to let me know. I don't know if it says it gets processed online or not. Way out west, you've heard sharing policy info is common practice, but you just want to make sure. Oh, is sharing policy information between agents okay in your industry? In your industry, sharing info like that is a big no-no. Oh yeah, it doesn't matter in the life insurance industry. Not at all. The customer can shop around as much as they want to. There's agents out there that do not like to do illustrations because they don't want to get shopped around. Why do you suppose that is? Me? I don't care one bit. For one thing, I can't service every client out there. I'm just one person. Right? I'm just one person. So what I see as my giving out illustrations that are designed really well, and me taking the time to show you what a proper design could look like, the best a policy could look like, you can take that and shop it around. I've got a guy that I'm working with right now. He did a Guardian application with me, but his wife was working with another agent doing Allianz. As we know, Allianz is one of my favorite companies. And so I was like, you know what? I understand you got this other agent doing Allianz for you. Let me give you an illustration that you can take and get a better design policy from that person with. And that's what we did. I designed it for him. He took it to the guy. He said, hey, can you do this? And the guy said, no, we can't do that. Allianz may display a 10-to-1 split, but it won't actually be that way. It'll only be a 2-to-1. And so he came back to me. He said, hey, this guy said this. And I was like, nah, that's a bunch of crap. That's not true at all. I don't know what he's talking about. And I showed him, I've got policies out there right now that I've sold that have that 10-to-1 design. So he gets to go back to that other agent and say, no, it does work this way. And that's how we'd like to have it designed. So by getting this information out there, you become a more informed consumer. You can get better policies. You can demand better designs from your agents. And if those agents learn how to design better policies, I think that helps out the whole industry. Because I kind of get tired of all the people that say, whole life is terrible, or IULs are terrible. And what they hold up as examples are these terribly designed policies that have massive fees and pay huge commissions. I don't get huge commissions for the policies that I design, and the policies work great. So, yeah, so there's that. But yeah, we share illustrations all the time. All the time. My voice is about dead here, guys, so I'm going to catch up. It looks like I'm right at the end of this anyways. But I'm going to have to hop out of here, so I have some voice for tomorrow. Adventure says, sounds good. It said that it should be approved in 4 business days, then the 2 to 3 days for ACH. All right, cool. That's kind of weird. That's a full 7 days, which is basically how long it takes them to mail out a check when I request a check. So, kind of funny. Jones, any other cryptos that I'm holding other than Doge? Not at the moment. I've bounced in and out of Bitcoin and Ethereum. But that's it. I just have Robinhood. It's not a great platform for doing crypto. And I'm not a patient person. And I have a lot of time that I can watch it move. So when I'm watching it move and I see it go down, I can't hold. I have a really hard time buying and holding crypto. Because I think, oh, we're at a high point. I'm going to get out and I'll get back in down lower. And eventually I miss the shoot up. So it's not the best way to trade crypto. Not the best way by far. But way out west, my email is james@OregonCashFlowPro.com. James@OregonCashFlowPro.com. And if you just go to my website, you can get it there as well. OregonCashFlowPro.com. There's a link where you can send us an email. Hesleg, you're interested in getting a pool built. Do I have any recommendations on how you can go about doing this? You know this isn't market or insurance relatable, but you're in need of some advice. Yeah, are you trying to get an in-ground pool built or an above-ground pool built? I would definitely start by Googling the places in your area, because I guarantee you there's some pool places in your area. You can even check YouTube. You can check YouTube. Oftentimes, those major companies will have videos of jobs that they've done. And you can see how they put the pool together. So it gives you kind of a good idea of what they can do. You can always shop around if it's an above ground pool you're doing. Those ones are fairly easy to put together yourself. Depends on what you want to get done around it. It can get very complicated. So check in with whoever your local pool company is. They will be able to recommend to you contractors. Ones that they've worked with, ones that they can refer, ones that they feel confident referring. Okay? Doesn't mean that those places are the best or the most affordable, but that may not be the top of your wish list. Number one thing, an in-ground fiberglass pool. Okay, so number one thing for you is going to be somebody who knows what they're doing. Somebody who has a history of good work. I would check with your local pool company, get some recommendations. They probably have their own installers that they work with as well. And so you can get a quote. You may even have multiple pool companies that you can compete with. Or that you can get them to compete against each other. Adventure, you wrote in but should have said within. Oh, it said it should be approved within 4 business days. Gotcha. Okay, cool. Cool. Yeah, so good luck, Hesleg. Pools are expensive, but they can be well worth it. They can be well worth it. My kids love a pool. Unfortunately, they don't have one to swim in because I haven't quite finished ours yet. We're just working on an above-ground pool. So, all right, and with that, we came to the end of our questions. I'm going to call it a night and let my voice rest. All right, thanks, Way Out West. I'll take a look at that and let you know what I think. I appreciate you guys being here with me today. Thank you for the donations. Appreciate you guys hitting the like button on your way out. Subscribe if you haven't subscribed. I'm live every day the market opens. We do day trading of Tesla and general talk about the stock market, everything going on. I meet with folks throughout the day for life insurance, high cash value design life insurance. I meet with people to talk about their finances, help with infinite banking, dynamic banking, helping you maximize your cash flow. That is my goal here, to help you maximize your cash flow. So if there's something I can do to provide you with some value, let me know. I will do the best that I can. And with that, I will bid you good night. Gonna play you out with some music, and we'll see you next time. Good point, Tony.